Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar, the news you need to know for the week ahead in Bitcoin. Today is Monday, March 22nd, and we have a week loaded with market-moving events. To start, or on top for today's discussion, the Federal Reserve ended the SLR exemption that we've been talking about at depth here over the last few weeks. We're going to talk about what happens next. We're also going to talk about how rising interest rates could impact Bitcoin. And lastly, we're going to share some portfolio tips from none other than Ray Dalio from over this weekend and what to do in these environments. So without further ado, onwards to our analysis. So starting as we usually do with Bitcoin, we saw that Bitcoin sold off slightly last week during stimulus check week, closing the week down 2.77% at $50,381. Now, interesting to note that the S&P 500 and the Dow Jones Industrial were also down for the same weekly period, with the only major index in the US rising being the Nasdaq. So we're going to talk about that in our following section. Now, there were positive developments for Bitcoin during the week, namely one of the main ones, the one that I'll pop here behind our screen, is that the Visa said it's working to enable Bitcoin purchases, and this was stated by their CEO. In other news, it basically went into details saying that it is looking to enable purchases of Bitcoin on Visa credentials. Now, going back to the graph, we see that price action, considering the backdrop, may signal that some investors are selling into the momentum of the stimulus checks, and we're also heading into another options and futures expiration week this week. Actually, those contracts will expire this Friday, March 26th, which expiration weeks tend to be volatile periods. So it's something to keep in mind. Now, another interesting thing that we wanted to highlight was that we wanted to take a quick look at the last two 10-week periods for Bitcoin. So if we take the last week and we go back basically 10 weeks, so if you see this, in the last 10 weeks, we've had 4 down weeks, 1, 2, 3, and 4. And if you add up all the retracements from those negative weeks, you total essentially a cumulative drop of around 40.2% during those 4 weeks. Now, if we look at the previous 10-week period, so this candle here, all the way to here, we see that it only had 2 down periods, or 2 down weeks, and those totaled a cumulative drop of 2.45%. So something to keep in mind, as we can see that the volatility is basically accelerating, and it's now not only showing up on the upside, it's showing up both on the upside and the downside. So a couple of other interesting points. Now, as a result of the recent price action, the perpetual futures funding rates for Bitcoin across major exchanges are mixed. And we're going to show you what we mean. So if you look at the Bitcoin perpetual future on the funding rate for that perpetual future on the Binance exchange, the current rate is at basically 0.05%. And if you look at their 30-day average, it's 0.03%. So it's quite a little bit higher than its 30-day average. If we look at FTX, it's currently sitting at a similar number, 0.044. And if you look at the 30-day average there, it's actually 0.028. So we are seeing that across FTX and Binance, the perpetual futures funding rates for Bitcoin are quite substantially higher than their 30-day averages. This could be another sign of potential volatility going into this week. Now, on the options side, just to pop over the March contracts again, because we're heading into expiration this week, we see that on the call side, most of the open interest, and that's this number here, I'm trying to see if I can highlight it better. That's essentially, it's this number, the number here on this row. We see that the open interest for the call contracts are quite evenly distributed. We see a bit of volume here on the 60,000 contract. There's also a significant one on the $80,000 contract, as well as 88 and 100. The implied volatilities here are basically all north of 100. And if we go back and look at the put option contracts, which is the ones that are on the right side of the screen, we see that, again, those are pretty evenly distributed with the bulk, or I guess a significant amount of interest or open interest in the $40,000 and the $44,000 level. So again, nothing that sticks out immediately right now. They all seem to be pretty evenly distributed. There's that $40,000 contract on the put side that seems to be have quite a lot of open interest, but is quite out of the money going into the expiration. So we'll see how this plays out. But just wanted to highlight some of the basically larger open interest contracts in the options markets. Now, again, to bring it back to the sort of more high level or general environment, the rising treasury bond yields took the spotlight again last week. And interestingly, these can be interpreted as investors pricing in future inflation, which is good for Bitcoin in the long term. However, it could have negative short-term effects for Bitcoin due to some market dynamics that we're going to get into in our What's Ahead section later today. Moving on to the S&P 500, we see that it closed last week down 0.86% at 3,909 points. Most of the drops, if we can go back to the daily, we see that most of the drops last week basically came on Thursday and Friday, and that was because of the news we already covered, which was that the Fed stated that it would be ending the emergency capital relief for big banks. That is that supplementary leverage ratio, or SLR exemption, that we have been discussing over here over the last 3 weeks. To show you the headline, this is essentially the headline that came out of the Federal Reserve. Wall Street Journal covered it, saying that it would end the capital relief for the big banks. So again, that took the spotlight and essentially sent the Treasury yields soaring last week. Let's just pop up the yield on the 10-year note. Again, we see that it climbed 5.93% last week. And not only that, but, actually, again, just an interesting point to note, over here, or in the economic calendar about 4 weeks ago, we touched on the 1.75 level on the Treasury yield being an important level to watch, and we see that it actually hit a high of 1.75 last week, ended up closing the week at 1.73. But again, interestingly, what we're seeing here is that Treasury yields have been essentially now rising for 8 consecutive weeks, and that is quite interesting. And the other relevant pieces of news that have come out have been that both Jamie Dimon and Ray Dalio saying that they would not touch a 10-year Treasury note with a 10-foot pole. So, strong words coming out of such important or prominent bond managers or market participants. But, as we highlighted here, we see that it's very clear that the yields on these notes are rising quite fast. And if that has become the consensus view, then what market participants will want to anticipate is, one, how high can these go? And two, what impact could that have in his or her portfolio? So we can try to look at some clues and try to answer some of these questions. For the first one, we can take a look at some investor sentiment around when investors believe that bonds can become cheap relative to stocks. So what yield does that get triggered? When bonds rise, the price of their bonds. When bond yields rise, the price of the bonds drop, and at some point they will become attractive to own. So let's take a look at some recent survey data from Bank of America. And here, I thought this was a very interesting chart because basically it surveyed a bunch of fund managers to see when they would think at what yield they thought the treasuries became attractive relative to bonds. And we see the vast majority of the respondents here, close to 35%, said that 2.5% interest or yield is that magic number. So that's an interesting signal. The other one is there is no mention of the 1.75 level, the level that we're at now. And we see that there's very little interest in the 1.5 range. So by and large, most of these investors do feel that rates will continue to rise, and it's still not yet attractive to own bonds relative to stocks. If we look at, if we try to estimate what the tipping point is, so the point at which more than 50% of investors believe that it is attractive to own bonds over stocks, that's somewhere in between 2 and 2.5%, so somewhere north of 2%. Now, why is this level so important? and for this, I wanted to bring you back to the chart here. So if we essentially zoom out of this chart, this is the 10-year note on a very short time frame. If we zoom out of this on almost just trying to take a look at a 10-year trend, here you'll start to see that in essence, the trend on the yield of treasury notes is pretty clear. It's pretty clear downwards and to the right. However, that 2%, 2.5% level is somewhere around here. It'll have to be 2.5 here, but 2 and 2.5. It's basically this area that we're talking about. And why this area is so important, as you can see the trend line here, is that if the yields do get to anywhere near this range, it would essentially start to challenge this 20-year long trend on the treasury yields. And that would have a bunch more people asking a whole different set of questions. So that's why that level is so important here. And I just wanted to highlight it just so that we can put it in context based on the 20-year trend for the yields on these notes. So again, something to keep an eye out. And we're going to discuss how rising interest rates or rising bond yields could impact Bitcoin in our What's Ahead section later today. Moving over to gold, we see that gold did catch some footing last week, finishing last week up 1% at $1,744 per ounce. Interestingly, the rally in gold essentially shook off also a rally or a rising dollar, which is interesting. It shows a bit of sign of strength, something that we haven't seen much of from gold recently. And there was a very interesting tweet over the weekend over last week actually, by Lynn Alden, and I just wanted to pop up that tweet here, which essentially shows that gold is still inversely correlated to real rates or real long-term rates, meaning that as real rates go higher, gold goes lower. Another interesting point that she highlighted was that gold is about fairly valued versus the per capita growth of the M2 money supply in the United States. And you can see that in this chart. We see that gold prices basically seem to be trending that M2 money supply level, which was interesting to watch. And, to bring it back to the chart, this will be a very interesting dynamic to keep an eye out as treasury yields continue to rise, because there's going to be a situation or a period where both the yield is continuing to rise and so are the inflation expectations. So essentially, the difference between those two is what creates that real rate of return. And we'll see essentially how gold reacts in these environments of both potential rising interest rates and potential rising inflation expectations, and what that does to that real rate of growth or that real rate of interest for bonds. Moving over to our DeFi analysis, we see that even though both Bitcoin, just taking a look at the weekly candle from last week from Bitcoin, and Ethereum, again, weekly candle from Ethereum down last week, even though both Bitcoin and Ethereum were down last week, DeFi bucked the trend and actually closed the week slightly higher at 1.48% higher for that weekly period. Now, while there have been no further developments out of or from that potential looming legislation out of the US, we are starting to see the first glimpses of support or institutional support for Ethereum, with Meitu becoming the first publicly listed company to buy a piece of Ethereum in addition to Bitcoin for its reserves. And I'll just show here that's the news that we're talking about. So Meitu is a publicly listed Chinese technology company, and it has started being touted as Asia's MicroStrategy. Time will tell if other publicly listed companies in China follow suit. Nonetheless, it's fascinating to watch how much of a global phenomenon essentially crypto assets have become across corporate treasuries and corporate boards around the world. Moving over to our Bitcoin mining difficulty commentary, we had a new difficulty adjustment kick in last Friday, which brought our mining difficulty to a new all-time high of 21.87 terahashes. Now, switching gears for a second to the mempool, we see back here that the mempool is still pretty clogged relative to historical levels, so you can expect transaction times and fees to be similar to what they have been in the last 14 days, so you can plan your transactions accordingly. Now, as always, we leave you with what's ahead for the week. There's a couple of very important market moving events into the coming week that we wanted to basically highlight at the very beginning of this section, which is the chairman of the Federal Reserve is scheduled to testify before Congress twice this week. And there are also a dozen of other Fed speeches scheduled for the following week. Now, as per the headlines that you've seen probably on financial media, this could be a source of volatility for the markets this week, given so much focus that's around the treasury markets right now. In addition, another potential market moving event is that we have GameStop earnings coming out on Tuesday. So again, something to highlight going into the week. Now, another interesting point that we wanted to cover was that none other than Mr. Ray Dalio, who is a bond market expert and the head at Bridgewater, gave an interesting interview over the weekend in which he essentially shared some portfolio tips for the current market environment. In their interview, a few of the things that we wanted to highlight that Mr. Dalio said was that, and I quote, Mr. Dalio said that cash is trash right now and that holding you costs you or the investor around 2% annually. According to Mr. Dalio, that is a lot. And his advice for this environment, his portfolio advice for this type of environment was that, well, one, do not hold cash. If anything, borrow cash to buy something else. And secondly, he said that diversification is very important. He said investors or portfolio managers should make sure to own assets across different asset classes, exposed to different currencies, and in different geographies. So those were, again, very interesting tips from Mr. Dalio. You can look up the interview he gave to Bloomberg over the weekend and check it out if you'd like. Now, in addition, let's move on to, let's chat for a second about rising interest rates or rising bond yield, which can lead to rising interest rates. That seems to be the consensus view right now. And we wanted to talk about how that could impact Bitcoin in the short term. So if rates rise enough, it'll put pressure in the stock market. This happens due to the dynamic that we've covered in previous issues of the economic calendar. When this happens, high growth stocks, namely in the technology sector, tend to suffer the most because they have the most growth into the future. This impacts Bitcoin because selling pressure in growth and tech ETFs funds like ARK increases. Now, ARK, just to give an example, one of the ARK technology funds owns GBTC as one of its underlying assets. As the fund size gets smaller because investors essentially take money out of the fund to take it into other sectors, the fund has to trim its long GBTC holdings, which in turn puts downward pressure on Bitcoin prices in the spot markets. Now, similarly, as bond markets become more attractive to own relative to stocks, basically, as that becomes more attractive to own, investors may look to essentially start trimming some of their long stock positions and going into bonds. Now, if a long stock portfolio has exposure to stocks like, say, MicroStrategy, GBTC, or any of the other Bitcoin-related trades in the stock market right now, that size of that allocation will also be trimmed, which will again have a similar effect by putting selling pressure into GBTC shares, which will then again put downward pressure into Bitcoin spot prices. Now, in the long run, this selling pressure should net out with the immense pressure to put dollars to work and shield from inflation. And the long-term trend upwards for Bitcoin should be resumed. However, it is always good to understand how pressure on growth and tech stocks could spill over and affect Bitcoin. Lastly, kind reminder going into the week that this is a options and futures expiration week for the March contracts. Again, and another thing to highlight is that we're also heading into the final week of commentary for that potential law or legislation out of the United States Treasury Department to regulate digital asset transactions. So again, there could be a lot of developments basically hitting markets this week. So it's always good to stay on your toes and stay informed. As always, we'll keep you posted with any relevant information or news through our social media account or right here through the economic calendar. If you like today's episode, if you have any questions, please drop it down in the comments. We'll be happy to cover it in the next issue. If you enjoyed the show today, I welcome you to subscribe to the channel and like it and share it to your friends. If you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning 6% on your Bitcoin and 12.5% on your USDC. Thanks, everybody. Have a wonderful week and see you next time.